Good morning, good afternoon. I'm Johnny Lynum, and thank you for taking the time today. I know your schedule is busy, so I want to make sure every minute we spend together is generally useful for you. What I put together today walks through a strategy that a lot of commercial real estate owners in your position don't fully know about or think doesn't apply to them. But by the time we're done today, you'll have a clear picture of whether this is worth pursuing further. The presentation is called 1031 Exchange and DST Investing. The tagline on the screen really does capture it in three phases: defer taxes, grow wealth, and eliminate landlord headaches. We're going to unpack each of those today. The theme most owners in the situation are quietly dealing with. Before we get into anything today, I want to put our full disclosure in front of you, and I mean that sincerely, not as a formality. Take a moment to read through these if you'd like. The short version is this: nothing I share today is tax advice, legal advice, or a recommendation to buy or sell anything. I'm here to educate you on the strategy, walk you through how it works, and help you figure out whether it makes sense for your situation. Any decisions you make should involve your CPA and your attorney, and I actually insist on it. The other things worth flagging up front: DST investments carry real risk, including the potential loss of principal. They're not liquid. You're typically looking at anywhere from a 2 to 10 year hold, with 5 years kind of being on average. And there's no guarantee that you can get out early. And these offerings are only available to accredited investors, which we'll confirm as part of the process if we get there. I lead with this because I think the worst thing I could do as a financial advisor is to bury the fine print at the end of the presentation and have you feel like you weren't told something important up front. You'll see our broker dealer information at the bottom. Securities are offered through Innovation Partners, LLC. And if you have any questions along the way, my contact information, definitely don't hesitate to reach out. All right. Now that we've got that out the way, let me tell you a little bit about who I am and why this work matters to me so much. And then we'll get into the strategy. Now, before I kind of walk through the strategy myself, really walk through the strategy, a little bit about me. So, of course, I'm Johnny Lynum. Spent 20 years in the U.S. Air Force, retired as a lieutenant colonel. And what that career really taught me more than anything was how to build a plan, how to execute it with discipline, and how to be accountable to the people depending on you. And I think I've applied that same framework to everything that I do in wealth when it comes to wealth strategy. On the licensing side, I hold my Series 65, 63, and my Series 22 license, plus life and health insurance. I'm a registered investment advisor with Innovation Partners that I mentioned, but honestly, credentials are the floor, not the ceiling. And what I think matters more than the credentials itself is that I'm not just an advisor talking about real estate. I'm an active operator. I've acquired and managed over 100 units across Virginia, Alabama, and Florida, including a 96-unit multifamily community. So I know what it means to own real estate, to deal with tenants, to manage capital, to manage investor relations, to think about exits. That perspective shapes every conversation that I have with my clients. I've also written 2 books on this: The Financial Security Blueprint and Millionaire Real Estate Success Strategies. And I run REI Genius, a real estate education community built specifically for investors and transitioning military families. And when it comes to how I actually work with clients, looking at the 4 things that set Lynum Capital Partners apart. First, tax deferral first. Really, capital gains deferral it isn't one of the options, among many. It's the lens through which I evaluate every recommendation that I give. We structure before we advise. Number 2, military discipline. Every engagement has a documented plan, clear milestones, and accountability. You'll never wonder where things stand. And then thirdly, institutional access. The DSTs I work with in multifamily, industrial, and healthcare are not available through retail channels. You're getting access to the same caliber of investments the major institutions own. And then lastly, number 4, full life cycle planning. I'm not here to close a transaction. I'm here to walk you through a 1031 into a DST, and where appropriate, a 721 exchange, a pathway that can carry tax deferral across generations and dramatically simplify your estate. All my contact information is right there at the bottom: phone, email, website, a direct scheduling link if you ever want to set something up on your own. And I usually respond with that one business day. So that's me, my background. Now let's go ahead and get started and dive into the presentation today and really start digging in on the things most commercial property owners in your position are quietly dealing with. Here's what I hear from commercial property owners almost every time I sit down with someone in your shoes. You built something, your property has appreciated significantly. Maybe you bought it for $1 million, is worth $3 million today. That's a fantastic result. You should feel really great about it. But now you want to do something with it. Maybe you're tired of managing it. Maybe you want to retire or rebalance or move your capital somewhere more productive. And then you find out how much of that gain you're actually going to get to keep and how much that tax bill is going to be. There are really three things that hit you all at once when you sell appreciated commercial real estate. First, the capital gains tax. Federal long-term tax rates are 20% for high earners, plus your state's rate on top of all that. In Virginia, I know right now we're at 5.75%. Combined, you're losing 25 to 30 cents on every dollar of gain before the IRS even touches the depreciation. Second, the depreciation recapture. Every year you've owned the property, you've been taking depreciation deductions, which is great for taxes in the meantime. But when you sell, the IRS wants it back at a 25% rate. That's on top of the capital gains. And then lastly, third, this one isn't about the money. It's about the quality of life, the management burden. I've been there with managing value add apartment complexes, the questions, even if you have a third party property manager, you're getting the questions, you're getting the challenges, the fires, someone dying in the unit, and everything that comes with it. How many repairs, vacancy, late payments? Many of my clients, they tell me they've been thinking about selling for 2 or 3 years, but they felt stuck because the tax bill seemed to be so painful. They couldn't even bring themselves to even list the property to pull the trigger to go ahead and move forward. So I think one of the things you have to really ask yourself, does that resonate with you in your situation and where you are right now? And if so, then really digging in and understanding what this means to you and how this can benefit you and your position as you continue to want to move forward. So here's the thing. What is a 1031 exchange? Section 1031 of the Internal Revenue Code is one of the most powerful and most underutilized tools available to real estate investors. It's named after the section of the tax code and has been around for over 100 years. The core concept is simple. If you sell an investment property and reinvest the proceeds into another like-kind investment property, the IRS allows you to defer all your capital gain taxes indefinitely. That word defer is important. We're not eliminating the tax. We're pushing it out into the future. And in some estate planning situation, if the property passes to your heirs, it steps up in basis and the gain may never be taxed at all. But we'll come back to that. The exchange works in a very specific sequence, and there are hard deadlines the IRS will not bend on. Here's how it flows. Step one, you're going to sell the existing property. Right now, we're going to call it the relinquished property. From the date of closing, the clock starts ticking. Step two, you have 45 days to identify up to 3 potential replacement properties in writing to a qualified intermediary, or better known as a QI. This is the most stressful part of a traditional exchange. 45 days goes by very fast when you're trying to find, negotiate, and get under contract on a commercial property. Step 3, you have 180 days total from the sale to close on the replacement property, not 181, 180 days. And step 4, if you reinvested all your equity, you defer the entire tax obligation. $0 paid to the IRS on that tax sale. But before we talk about kind of the modern solution today, as we look at 2026 to those tight deadlines, let me walk you through the rules you have to follow, because if you miss any one of these specific rules, the entire exchange gets disqualified. So I want to be direct with you about this slide, because these rules, they matter an extreme amount because they're not flexible at all. The IRS design, back when they simply implemented these rules, back when we talked about it was in 1921, that with putting the rules in place, that they designed them to prevent people from just taking advantage of the system and being able to prevent people from using the 1031 as a prolonged tax deferral loophole. So they enforced them strictly. So come on, let's walk through the rules right now really quick. So rule one, the 45-day identification window. From the day you close on the sale, you have 45 days to identify replacement properties in writing. You can name up to 3 properties. Miss this deadline by even just 1 day, and the exchange is dead. You owe all of the taxes. Rule 2, the 180-day rule. You must close on your replacement property within 180 days. Again, no exceptions, no extensions, unless you're in a federally declared disaster area. You have to adhere to this rule. Rule 3, 100% equity reinvestment. To defer the entire tax amount, every dollar of your equity has to go into the new property. If you take any cash out, even accidentally, that's called boot, and it's taxable immediately. Rule 4, and I would say this is the one of the most critical, you must use a qualified intermediary, or QI. You cannot personally touch the sale proceeds at any point during the exchange. The QI holds the funds between sale and purchase of the new property, and if the money hits your bank account, even for just 1 day, the exchange is disqualified. You know, one of the things that the questions that I get a lot of time, what if I've already sold my property and haven't set up a QI? If the proceeds have already been touched to your account, and then you're pretty much out of being able to do a traditional 1031. It's off the table. But depending on the timing, there may still be options, including a reverse exchange or structuring strategies worth reviewing with your CPA. But let's talk about your specific timeline. You know, if we're able to set up a call in the future, it's something that you want to look at, we can definitely have those conversations. So now you kind of understand the rules. The question is, how do you find a qualified replacement property in 45 days, close in 180, and then reinvest all the proceeds and do all of that without any headaches of becoming an active landlord again? That's exactly where the Delaware Statutory Trust, the DST, comes into play. A Delaware Statutory Trust, or DST, is a legally structured entity that allows multiple investors to hold fractional ownership interest in a single large piece of institutional grade real estate. Think of it like this. A professional real estate sponsor goes out and acquires a $40 million Class A apartment complex, or a Walgreens anchor retail center, or Amazon distribution warehouse. Then they offer fractional ownership interest in that property to accredited investors, people like you, starting at as little as $25,000 or $100,000 for a share. So back in 2004, the IRS issued Revenue Ruling 2004-86, which explicitly confirmed the DST interest qualifies as a like-kind property for 1031 exchange purposes. That's the key. You sell your existing property, your commercial building that you own, your QI holds the money, the proceeds at closing, and instead of scrambling to find and close on a replacement property in 45 days, you simply invest in a DST, a process that can be actually completed in a matter of days. It's not that long. So the types of properties held inside DSTs are institutional quality. So the same caliber of assets that you're going to see with pension funds, endowments, and REITs, the same properties that they all own. We're talking about Class A, multifamily, and high growth markets. So think the Dallas, the Phoenix, the Charlottes, continued growing markets, Miami, Los Angeles. You're going to have in those markets, you're going to have net lease retail type of properties with national credit tenants, industrial and logistic properties leased to Fortune 500 companies. These are not the type of deals you typically have access to on your own. A $50 million industrial park requires $50 million. A DST lets you own fractional interest in that same property for a fraction of that amount. And it just allows you to get all the benefits that come with this with only owning just a fractional amount of it. And so let me walk you through the specific benefits, because there are really 6 distinct advantages on why you would use a DST for your exchange. So let's start with the first one. And we're really going through these. I want to go through each of these because depending on your situation, 1 or 2 of them are going to matter much more than the others. So benefit 1, truly passive income. Once you invest, your job is done. The sponsor manages everything: property management, maintenance, leasing, distributions, capital improvements, tenant relations, Everything is taken care of by them. You receive those monthly distributions deposited directly to your bank account. No calls, no contractors, and no decisions. Benefit due. The 45-day deadline becomes manageable. The DST offerings are prepackaged and ready to close. You can review offering materials, sign a subscription agreement, and wire funds within days, not months. If you're already in an exchange and running out of time, a DST can be a lifeline because you don't want to bust that 45-day clock. Benefit 3, institutional grade assets. You're stepping out of whatever you're managing today into the same caliber of real estate that major institutions own. Professional management, modern properties, and credit grade tenants. Benefit 4, continued tax deferral is really key. Your capital gains and depreciation continue to be deferred for as long as you stay in the exchange. And with proper estate planning, your heirs may receive a step up in basis at your passing, meaning the deferred gain disappears entirely. And so a lot of the strategies, when you look at, a lot of clients may look at the 721 up REIT, where now you have a REIT that purchases the DST, and now you own operational units of the actual REIT. And now with the quarterly distribution windows where you can go in and you can liquidate shares based off of however you want to take capital. But a lot of times, clients that are looking at the estate planning side of it, that now they just gift those operational units that they own the REITs inside their estate plan, inside their trust. And now they have their step up in basis and they have a liquidated asset that they can monetize and bring in to now they're not passing down real estate that they have to worry about their heirs having to manage or to break up evenly amongst multiple heirs. And so now just having the operational units that you can sell on the market and have those distribution windows that open up, it allows you to take back control on how and how much you want to liquidate at any given time on your portfolio. Benefit 5 is the diversification. Rather than concentrating all of your exchange proceeds in one single replacement property, you can spread your equity across 2, 3, or more DST offerings and build a true portfolio that gives you different property types, different sponsors, different geographies. That's risk management, which is extremely important. And then benefit 6, lower minimum entry. Traditional 1031 exchanges require you to replace like with like, which often means buying something as large as what you sold. DSTs allow you to deploy $500,000 across 5 different offerings if you choose, or put it all in one. It's extremely flexible. And I think one of the great benefits to clients is you're not rushing to buy a horrible property. You're not getting a bad deal that has underlying issues that you don't know about, that you're going to have to throw more money at to improve the property, to make it rent ready. And so you're not having to deal with those active management challenges. That now you're buying a grade A property with a tenant already in place that's already producing cash flow from day one. For a lot of people, they say, hey, Johnny, this sounds like a REIT. What's the difference? And it's always a great question because REITs are publicly traded and don't qualify for 1031 exchanges. DSTs are private, direct ownership interests that have specific real estate assets. When you invest in a DST, you actually own a beneficial interest in actual property, which is why the IRS recognizes it as a like-kind property. The REITs are securities, DSTs are real estate. And so when I talked about the 721 up REIT, that's just simply the REIT buying that property. And now those operational units, now you own a security and you can gift those securities to your heirs. And now you have the options to liquidate those securities usually on a quarterly basis when they have those open windows where you can look at liquidating some of your shares that you own with those securities. So now let me show you what it actually means in dollars, because the numbers are they're pretty striking when you actually sit down and look at it. I built this comparison around a hypothetical commercial property. So $1 million original cost basis sold today for $3 million. That's a $2 million gain. The owner has held it for 15 years and claimed $400,000 in depreciation. It's a completely realistic scenario. Now let's look at what happens if the owner just sells versus doing a 1031 DST exchange. So walking across over here on the left side, selling without the exchange. If they sell without the exchange, here's what the math looks like. Sales price $3 million, adjusted cost basis after 15 years of depreciation is about $600,000. That creates a $2.4 million taxable gain. Federal capital gains tax at 20% is 480,000. State tax at 5% for a state like Virginia is 120,000. And the IRS charges 25% on that 400,000 of depreciation that was claimed, which is another 100K. Net proceeds after taxes, drum roll please, 2.3 million. Out of a $3 million sale, $700,000 went to the government. Now let's walk on the other side, looking at the right column. Though if we actually implemented the 1031 DST exchange. Now in this example, now look at the DST exchange column. Same $3 million sale. All equity is reinvested into the DST. Federal capital gains tax is zero. State tax is zero. Depreciation recapture is zero. The full $3 million is working for this investor. That's $700,000 more capital that's now invested in an institutional real estate, generate monthly income, and continuing to grow. Compounded over 10 years, that difference is profound. So one of the things that I key in that is like the tax is deferred. What does that mean? How does that compare? So the answer to that is deferred. It's not completely wiped out. So yes, eventually, unless you do another 1031 exchange, when the DST whole period ends, which typically gives you the option to do just that, or if the property passes to your heirs, the basis steps up to a fair market value, and the deferred gain is extinguished. Many clients use a combination of continued exchanges and estate planning to ensure that the deferred gain is never actually paid. Your CPA and the state attorney should be part of this conversation. And so that's some of the things you were talking about with the 721 UPREIT, with that strategy and bringing that in with the estate planning, with your trust, that there's a lot of conversation that happens with myself, your CPA, and as well as your estate planning attorney to make sure that you have a coherent, comprehensive plan that closes, that works out well for you and just your overall estate planning. But before you get too excited, I want to be fully transparent with you about the limitations and risks, because the understanding those is how you make the right decision. So we'll go to the next slide. So what are the risk limitations and who qualifies? So I'm going to take a few minutes on this slide because I think this is where your trust in me as an advisor and just my fiduciary obligation is either earned or lost. I'd rather over communicate the limitations than have you invest in something that isn't the right fit. DSTs have what's called the 7 deadly sins in legal terms, a set of restrictions baked into the trust structure by the IRS. Let me translate that into plain English. So number one, no new financing after you invest. The debt structure is set at the time the sponsor acquires the property. You can't lever up or refinance to pull cash out. Number two, no capital calls. If the property needs a major repair or capital improvements that the reserves don't cover, the sponsor has to find another way to fund it. You'll not be asked for more money. Number three, no major improvements. DST trustees cannot initiate significant physical improvements, which means you can't force appreciation through value add strategies. These are typically stabilized, income generating assets, not development projects. Number four, these are illiquid investments. There's no stock market that you can sell your interest on tomorrow. The typical hold period could be anywhere from 2 to 10 years, with most being somewhere around the 5-year mark. But you should only invest money you won't need during that window period. And then number five, accredited investor status is required. You must have a net worth of at least $1 million, excluding your primary residence, or annual income, if you're a single individual, of $200,000 or more in the last 2 years, and with the expectation to make the same amount this year. Or if you're a married couple, $300,000 of annual income the last 2 years, with the expectation to make the same amount this current year. But a lot of those things are confirmed during the subscription process before making the investment. The ideal investor profile really is extremely important to me, especially when I'm looking at suitability for a client and understanding where you are right now in your journey and why this is an ideal investment for you. So, now we're kind of go through and kind of look at the strategy to who this is really well suited for. So those property owners who are tired of the active management burden, investors who want passive income in retirement, people facing large capital gain bills and looking for legal deferral strategies, those who want to diversify away from single tenant or single geography risk, and property owners who really want to set up their estate plan in a way where they can benefit from the step up in cost basis at death. If any of those describe you, then this definitely the conversation is worth having and really going through and understanding. Because a lot of times you want to make sure that the investment that you're making that is really structured for you. And so what does that step-by-step process look like for those that are interested in kind of learning more? And the thing is, my goal is to really make this manageable and make sure that it feels concrete to you and not abstract. And so really kind of let me walk you through the process and what that looks like, from today and kind of the next steps. And so really step one is really setting up that consultation. Before any decisions are made, you need to sit down with three people: your CPA, your attorney, and a 1031 exchange advisor like myself. The CPA confirms the tax analysis specific to your situation. The attorney reviews the paperwork, your ownership structure, your estate implications, and I help you understand the DST options that match your equity and income goals. Step two is really going next. The next step is listing and selling your property. Engaging with a qualified real estate broker for your commercial asset. If you don't have one, I have a ton of commercial brokers across the U.S. that I have a relationship with that we can get you set up where you can have someone that really knows your goals and how they can serve you in the best manner and get the property listed and sold. Critically, before you sign the closing documents, you need to make sure that you have that qualified intermediary already engaged. So you list your property for sale before you go into contract, but definitely before closing, you want to have that QI, have those conversations up front. I know work with multiple QIs that we can have you set up with an interview and see who really works best with you and really is a good fit for you as you're going through this transaction, because the QI agreement must be in place before the sale closes and not after. Step three, we're going to identify those DST offerings. Once you're in the exchange, I'll be able to walk you through the current DST offerings that are available that match your criteria. These are real properties with real financials, offering memorandum, rent rolls, financial projections, sponsor track records. You have time to review them carefully within your 45-day window. Then we move to step four, the investment. You review the offering memorandum, sign the subscription agreement, and the QI wires the funds over directly to the DST trustee. The whole subscription process typically takes 2 to 5 business days. Step five, collect income. Once the investment closes, you just start receiving monthly distribution. Typically, it's going to be deposited directly into your bank account. At year end, you receive a K-1 for tax reporting. Your role is completely passive from this point forward. And so one of the big ones that, the conversations that I have with questions, with clients, that how do I know the sponsor is trustworthy? Who are these operators? Because you're betting on the jockey on this one and their ability to deliver. And that's exactly the right question to ask. We only work with DST sponsors who have established track records, typically 10 or more years in the industry, hundreds of millions, if not billions of dollars in assets under management, and transparent reporting. I'll share sponsor profiles with you guys, track records with you as part of the due diligence process. And you should never invest in a DST without understanding who's managing it. With my broker dealer innovation partners, they can do another level of due diligence, and we only provide opportunities that have been vetted by myself as the advisor, but then also at a higher level with my broker dealer who's vets these deals up front. And so the question isn't really whether this strategy works, because there are billions on top of billions of investing in DSTs every year, but it clearly, it has to be for the right person and done correctly, adhering to the IRS rules. And the question is whether it's right for you specifically and whether you're ready to take that first step. And let me show you what that looks like. And so really, now we've covered a lot of ground today. And really, I want to respect your time and understand, hey, if we need to have further conversation, what that actually looks like. And I think for most people, that concrete next step is a one-on-one, no obligation, short call with myself to kind of go through and understand, hey, how are we following up? What are you thinking? What is your scenario? Maybe some specific questions that you have that I can answer. And it's really no agenda, and really just to dive in on your questions that you have. And if you have some of those questions, maybe you talk to your CPA already, you talk to your attorney, by then even better. And I can answer those other questions, or one of the things that I offer completely free is to have a personalized tax deferral analysis on your specific property. So if you have a property and you're thinking about selling, you're on the fence, then we can actually use your actual numbers, not anything hypothetical like I did on the slide when I showed the $3 million example. It's complimentary, it's confidential, and it gives you something concrete to point to upfront with your CPA to kind of drive that conversation. And then lastly, option 3, if you want to start exploring what actually, is available right now, I can share, a handful, 2 or 3 of current DST offerings that potentially match what you described to me in your situation. And we can look at those real properties and those real financials and projected returns and see if any of those are a fit for you. So if any of these feel like a good next step for you, definitely reach out to me. Just go to my website, johnnylynum.com/call, and really just go in and book that conversation so we can have it and kind of go through your situation where I can be a resource, whether you work with me or not. The goal is to give you the information that you need so you can be informed, because this is an extremely important time and high stakes where we're talking about hundreds of thousands of dollars of investments that could be lost or, reinvested depending on your adherence to these rules and really working with knowledgeable professionals. And so I really appreciate your time today and listening in on the webinar. And if anything I can do to be a resource, just definitely johnnylynum.com or, reach out to connect with me on LinkedIn, or you can go to just Google us and, and give us a phone call. Would love to have that conversation and be a resource for you and your family as you're going through and continue to evolve your investment strategy and your portfolio for that next phase, the next chapter in this journey. I'm Johnny Lynum. It's been a pleasure, and we'd love to see you on the call here soon.